Welcome to Business Problem Solvers Podcast, where legal insight meets entrepreneurial innovation. Are you a startup founder navigating the complex legal landscape of entrepreneurship? Are you seeking practical advice, actionable strategies, and expert guidance to propel your business forward? Look no further. Eric Alspaugh is a seasoned attorney based in the vibrant startup hub of California, and he's thrilled to be your host on this exciting journey. In this podcast, we'll dive deep into the intersection of law and business, bringing you insightful interviews with a diverse range of industry experts, thought leaders, and successful entrepreneurs. From intellectual property and contract law to corporate governance and regulatory compliance, we'll cover the essential legal topics that every startup needs to know. Our guests will share their wisdom, experience, and practical tips to help you navigate legal challenges, seize opportunities, and build a thriving business in today's dynamic marketplace. So whether you're a seasoned entrepreneur, a budding startup founder, or simply curious about the intersection of law and business, join Eric on Business Problem Solvers Podcast as we explore the legal insights and entrepreneurial inspiration that will fuel your journey to success.
Hey, John, welcome to the Business Problem Solvers Podcast. And to my listeners, I want to introduce you to John Samuelson, a friend and colleague here in Southern California. I've had pleasure of going to events and hanging out with John for the last 5 years and had some very fun experiences attending blockchain conferences and things like that. And I'm really excited to get John's insight on family venture capital and family offices and help some of you out. And John has particularly interesting background from my perspective because he's worked with NASA and he's done extensive deep diving and has experience as an electrical engineer as well. So his technical expertise and his business prowess should connect with a lot of you today. Hey, John, welcome.
Thank you very much, Eric. It's an absolute pleasure, and I'm looking forward to it.
Awesome. So what I'm hoping we'll do is just jump into some questions to help out entrepreneurs that are interested in how to maybe reach out to family offices to manage expectations, maybe some of the back and forth that might happen in some due diligence, and then any practical tips you might have. So if you want to tell us a little bit about maybe your background, how you got here, and let us know a few tips on getting the foot in the door with the family offices.
Thank you very much, Eric. I appreciate it. Yes, and the background is relevant, so I'll quickly get into that. I spent my initial career leading Fortune 500 developments in everything from deep water commercial construction, where I was operating as a deep water commercial diver in my youth, very early 20s, and then also in that leadership role. And then following a degree in business and electronic engineering, moving into the space domain, operating with NASA through various Fortune 500 contractors in leading developments for space station. And that emerging forward into medical device developments and international telecommunications for the emergence of the cellular systems that are obviously prevalent now, among some other areas in commercial aircraft and other areas. The fundamental of all that is that, to me, is that many times divisions or new projects in Fortune 500 companies, they really are analogous to operations of a startup or even a new business venture, in that the same fundamentals are there. Is there a business model? Is funding available? And many times, typically, looking for appropriate funding coming from the Fortune 500 company, which is analogous to going to an investor and presenting a solid case and a solid need for the funding and use of funds and all these things. So jumping forward, getting into venture capital with venture firms and their funds and family offices some 15 years ago. Getting into that domain was an easy transition because of the analogy between the two and fundamentally understanding from going into startup operations in Fortune 500 companies, knowing how to make sure to analyze if the team is formed correctly, where the holes are for execution and schedule, to planning, and also to the outside contractor that may be there, such as NASA or another Fortune 500 company, be it in aerospace or medical device development, and treating the investor in the same way of making sure they're knowledgeable in what's happening as you would a prime contractor that has an immediate need for integration of hardware coming together on very, very large scale projects and programs, as you know, pulling together a space station development. Everybody has to be on the same page for integration, and the fundamentals of managing that correlate over into a more streamlined way of how startups can operate to make sure that they're receiving the funding they desire from their strategic investors and also executing the plans that can be appreciated and supported by those strategic investors.
Awesome.
I can go on off it. I didn't want to talk too long without you being able to interject. I can move forward a little bit in some of the ways that a startup needs to be ready and for the investor, if that's helpful to
That's
you.
spot on. That's where I want to start exactly. And I think that's where a lot of entrepreneurs get hung up with. I go for it.
Okay, yes, and I deal with this on a regular basis, and it's actually one of my areas of passion. So I'm
Great.
really happy to be able to help your audience and anybody that reaches out later through you in this whole domain. Um, there's two approaches, right? There's a very, very new startup really isn't expected to have the expertise in knowing how to be ready on point with all of the materials and such. So they're going to go through that phase of getting things together. If they can pull that together or be coached how to get that together in an organized manner early on, the investors they initially meet are already going to have a sense that that startup or even that later stage company that is doing a raise for the first time, because you don't have to be raising funds right off the bat, you can grow organically, but it's best to make sure that you have all the materials in place: a deck, a brief, any of the at appropriate time frames, any sort of drafts of term sheets, and also to make sure that you have a data room set up that's easy
Yeah.
access. All these and others are clues to the investor that you've been operating in the space and you follow best practices in business, period, right? So if you're
Yeah.
doing things in this area, there's an initial implied belief that you probably are operating the rest of your business that way and that you have these best practices in place.
So
Opposite to that, many times a startup or a later stage company that hasn't been looking for funding will start with just a verbal word on, hey, we're looking to raise some money. And then, yes, great, you ask the appropriate questions and you find out sort of quick that they'll say, well, we have a deck to deliver or some briefing material, short stuff, right? Page, 3-page type things, along with a deck that's the appropriate length. And we can even get into that. But many times they'll say, yeah, we have that. Oh, it's just I'm going to get that back to you in a week because there's some things that I need to adjust in that. Well, it fundamentally tells an investor subconsciously that they probably don't have something that they're really ready to deliver, and they're brushing it up, and it really doesn't show that polished attribute that the startup or the later stage would like to present. You'd like to present, we have a data room, right? And it would be actually, I believe in the philosophy of two data rooms. One, a very simplified one, where there's a deck and a brief and some other non-proprietary information that you would
Okay.
be giving out to anybody. That would be an easy way that an investor can take a look and then also tell anybody on their team that may be more on their diligence team or otherwise, or hopefully you're hoping they're talking to other investors and saying to their business constituents in the industry and saying, hey, I reviewed a pretty interesting company today. Oh yeah, where is it? Well, look, here's their briefing. It's all in their data room, right? And that
Yeah.
they can get to that in a simplified manner. And again, easily delivered, would already be in an initial email in the footer of the information links and such, along with the website and things like that.
I like it. That's a great idea. So, spoon feeding people, making polished materials available easily really goes a long way.
Absolutely. And
Okay.
there can be a general concern from a startup or later stage company that they're worried about giving up proprietary information. Well, that can go in another data room that is ready for dealing with an investor on a longer scale. Um, the initial discussion is not meant to close the deal. This is nothing really new that I'm presenting in that regard. There's an old analogy about dating. You know, you're looking for a long-term relationship,
Okay.
and so you're giving an appropriate amount of information at a 30,000-foot level, and then down tighter.
Okay, I like that. What a question that I get, and I'm comfortable signing non-disclosure agreements, and I deal with some offices in venture capital. They just sign routinely, and some that say we don't sign. Do you have a preference or some objective gauge to share with the listeners on what their expectations really ought to be?
Thank you. Yes, absolutely. A fundamental is less barriers of entry for the investor and less speed bumps that the investor has to go over. If they have to add a password to get into the data room, it is a little speed bump that it may have not got handed over correctly within the family office's due diligence team or a family member within the family office structure. It, and so all of a sudden, oh, I couldn't get into it right now. Well, I'll get back to it later. Okay.
Yeah,
Well, that
missed
later
opportunity.
opportunity may not come around.
Yeah,
And
yeah,
in the area of NDAs and other non-disclosure speed bumps, it's all barriers of entry, and then somebody has to really review that and make sure that it's appropriate and it's time consuming, and then there probably will be some language that gets a need for adjustment, and all these things are building up. Meanwhile, you wanted the investor to be in the data room, and again,
gotcha.
the first
Yeah,
level data room, a brief, or even deliver it, over email. You want to get that to them. To that regard, on NDAs, there are many operations that have absolutely no interest, and I actually abide by this philosophy, interest in signing an NDA right off the bat. They're wanting to operate as lean as they can. They're receiving a multitude of investment potentials at family office dinners or otherwise, such as I was at last night, where a number came up and said, "Hey, we have a great opportunity here." Oh, that's really great, right? But so you generally there's a pretty broad scale philosophy of not wanting to sign NDAs, and the other aspect is you end up in a situation where somebody may have a great idea for vehicle mobility, but the investor's probably looking at a number of others that correlate over, and they don't want to get in something where they're off the bat looking at proprietary information that there could be a legal issue related to something they reviewed a year earlier or otherwise. So generally, the philosophy by venture capital firms and family offices, no interest in NDA. It's like,
Yeah, I tend to agree with you, but I work with the inventors, and they're always excited about sharing their secret sauce. Like that's the hook, rather than some of the materials. And I'm quoting you. You've referred to materials, and I want to follow up with you on what the materials are and your process. But real quick, a simple question in terms of numbers, if you're going to a family office dinner, I have a number that I'm familiar with. How many different ventures are you pitched in a year on average?
hundreds. And
Hundreds.
and that will vary when you get into, well, family offices, number one, they come in a wide range of types.
Sure.
You have some in the area where really they want to invest in funds, and they're not going to do as much diligence as one that may be operating in direct investing, where they're going to where they would be typically more hands-on in understanding the business because they have an internal capability and desire to do that. They may be even bringing up next generation, and they want the next generation to learn about the process and practice by doing it themselves, and then
Okay.
coaching back to the seniors of the operation.
Okay.
So, um,
Great
so
distinction.
to your question, hundreds will get
Okay.
delivered. And then some individuals they may be operating only in clean energy or AI, right? And they're just saying, they don't want to see anything other than specific areas that they're looking at. So it goes back again, lowering the speed bumps of the delivery and getting something into them, and just making sure you don't deliver anything that you're concerned about as being proprietary.
Yeah, you're highlighting my thinking and my point, which is I've heard that many VCs and family offices are looking at 600 opportunities a year. And so there's lots of great ideas out there. But folks, make it simple, spoon feed them. And I'm trying to manage my listeners' expectations and give them practical tips to be able to get the foot in the door and deliver. Uh, what did you call the room? A due diligence room?
Yeah, it can be phrases that, or a data room.
Data
And
room.
it to me, it shows a little bit more of a professionalism to be able to have a data room and a link on the back of your business card, a QR code on the back of the card that says data room, and other information, or the things that are you're trying to easily onboard them into your experience, and giving
Right.
these information points without them having to ask or separately emailing them and things like that.
Okay.
All these
Let,
help. They're not appropriate for every case, but everything that
sure.
lowers the impact of review.
Okay, so let's assume we ran into somebody at one of these conferences or dinners. They've given you the business card and the link. what is your process? Is it a common process, or do you have anything proprietary or tips for our listeners?
Sure. One thing in touching immediately before that, if you're presenting or meeting someone that is an investor, family office, venture capital lead, otherwise fund manager in private equity or otherwise, you don't want to inundate them with information unless you're getting feedback in that conversation that they want the information. An interchange of, you want to make sure that you have your 30-second intro memorized, and that if you're operating with others in the team, say you're going to a conference you're expecting to find a number of individuals there, and you brought your entire startup team, right, or later stage, but startup team, you need to make sure that everyone is operating that same 30-second message. So fundamentally, you want to make sure you write that down in advance. You don't have to have it word for word when you speak it out, but you want to make sure you deliver a 30-second and then look back for feedback. Is that other person giving you some sort of feedback saying, that is awesome. Can you tell me more about A or B or C? And then you can go in another level and make it interactive and make sure that they're interested to begin with, right? Before you go and start putting out a 3-minute verbalization, which happens a lot, right?
Okay.
You don't want to waste your time. If there's no interest there, you can make the contact and you both can go off in the whatever the event is, and you didn't disturb anybody, and you can follow up.
So this is more than this is a psychology class too. It's or just basic social emotional intelligence inventors. Just listen, look at your audience and listen back.
Very, very much so.
Okay.
As far as where you were going and related to, okay, typically there will be an investor deck that is provided. It cannot be extremely long. It should be around 12 pages, plus or minus. In other words, not 25 or 20. And there's several points that are well respected, and I can go into more depth another time, and I have a presentation on that actually of what are all the fundamental points in the order you should go through them on that make sure the investor is getting the key information that they typically are looking for. But
If you want to
fundamentally,
give
you're getting that. Again, easy onboarding for the delivery of the information.
great practical tip right there. So that's great opening recommendations for our listeners. What about your firm's process, more specifically on maybe onboarding? Let's say that they've set the hook, you're interested. What's some of the process that might occur?
Sure. Many times you can have an investor, family office or otherwise, that has strategic value to that startup. In those cases, there can be a bit of a difference in the due diligence process, because it's not all just about, does it make sense for an investment, but how can we provide strategic value back to that startup or that later stage company? And I may be a gift and a curse, but I tend to also think if there's some things that don't seem to be completely right in their plan forward, maybe they look light on engineering, or there may be a reason that you think that they're going to need more help in marketing or other planning out the door. A strategic investor that is accepted by the startup or the later stage will typically be happy to give advice And they also can be operated in that strategic relationship to provide proactive support throughout the investment. If they're a larger scale investor, family office or otherwise, the investor, either a venture capital firm or many times family offices, number one, their Rolodex is going to be really deep, right? In all sorts of various ways, such as I use you if I'm thinking about somebody that would need your best practices and things like that, and I think they're light, or others that are in engineering development or financial needs where they may need some augmented support in these areas. So that due diligence of going in and looking at everything in their data room, by the way, that we're a pretty good ways down from where we initially started at that point, when you're really
Sure.
getting in and doing deeper due diligence and you're really seriously considering an investment at a larger scale. If it's a smaller one, maybe you're doing it holistically and more thinking everything looks good, brief review, getting some understanding, some other more serious, deeper investors, and then just moving on. But on a larger amount, most likely there's going to be deeper review into the financials. I certainly coach in making sure that the team is understood and putting together ideas of how to augment that startup or that later stage to de-risk the operation and move revenue in closer to whatever their plan is. Many times we have looked at the operation and thought, okay, they're still looking for a strategic first client for their sales and otherwise. Well, family offices many times will have a multitude of appropriate first customers or secondary customers. And if you've appropriately gained their respect in what you're doing, they're more likely then to give a reference and pull in somebody else and say you're developing a product. They may be able to pull in a supermarket chain that may consider, okay, well, yeah, we'll put it on the store shelves in a few supermarkets and see where it goes. And maybe we'll take a little bit of an investment out of this ourselves, because we're talking this other family office that did do deeper diligence and is seeing this. We've done a number of business transactions with the others that have worked out. So you want to make sure that you're giving everything you can as that startup or that later stage to support your investors beyond them just giving you a check. You want to use them strategically when they have that value.
Yeah. A lot of people who are doing capital raise for the first time aren't aware. They hear things like what's good money and what's bad money. And I think the term strategic, the way you're using it, is pretty close to strategic is good money because you're leveraging relationships and expertise from individuals who either have a deep Rolodex or have a deep industry connection and can make introductions beyond just writing that check.
Absolutely, absolutely. And it's not a quick process of getting to a logical exit. Things come up over time of the years that the investment's transpiring. Sometimes things don't work out as planned, and other plans need to be pulled in. If the family office or the venture capital firm is a proactive, interested party as a strategic investor, they can actually, I actually fundamentally, I have a belief that it should be set up at the initiation that you use a strategic, well-operating investor as a strategic alliance throughout and bring them into periodic reviews where their expertise can be used to be able to work out some of the problems or come up with even new angles to the operation to move in revenue, de-risk any of the plans that may be taking place. And then also that investor is more likely to be doing bragging rights when they're talking to other family offices or other business relationships. And they're, hey, what have you got into? What have we gotten into? Well, we got into this water purification operation. And in fact, we just went to one of their business reviews and we really learned some interesting things, and we're helping them out in some business planning. These family offices didn't get to their wealth without extreme knowledge, right, and capability.
Absolutely.
And there's an ability to use that by bringing them in to strategic business reviews and not solely sending them a update deck periodically and then saying, oh, hey, we're in a new investment raise because we're going to need some new funds. You want to nurture them throughout the entire process. And there's some easy ways to do that.
All right. So we're walking through the process. We've set the hook. We're kind of assuming that there's a relationship that started, and we're working on communication and managing expectations. You brought up the issue of time, which is, I actually thought we should discuss how long the onboarding process takes. Months. Forget the exit strategy, which takes years. Maybe you can opine on different investments, different industries, and how that might impact maybe different levels of capital raises that you've seen, and can give some, I don't know, some anecdotal experiences.
Sure. Well, okay, if we're talking about an investment from an individual versus the entire raise, say that it's an investment raise of 1 million, but the individual investment from an individual, maybe it's 100K, right? It depends
Okay.
on who we're talking about, right? Angel
For sure.
investors, they tend to go in on lower amounts, 10K, 50K, whatever that the boundaries are in that kind of a domain, or more, but they tend to go in and they go in quicker typically because they'll do not the same due diligence if they're an individual as a firm would. And then we got the amount, right? And if as the amount goes up, typically there's going to be more due diligence done in that time frame, right?
Yeah.
There's a number of attributes tied to that, and I don't really look at it as there's really one answer. It could be lower amounts, and it could be a few weeks. And otherwise, it could take several months. Sometimes, family offices and other venture capital firms, well, they're not just necessarily sitting on money hoping tomorrow to invest in something. They have a strategic plan set for the entire FY24 or 6 months out. And maybe they've already allocated that, but you don't want to disregard them in that because you're building, certainly with family offices, you're building a relationship. And the last thing you want to do is come across needy and having, we got to get the money raised. We're trying to close this thing by December 15th, right?
Yeah.
You're building with family offices, you're building hopefully a long-term relationship.
Absolutely.
So that you can use their value, but also the fact that you're not trying to come across that you're needy, just like you do in any other form of business or relationships. And that process, depending on what else they're working on, it very well could take months.
Absolutely. So help me. We've been walking through the process. What what are the next steps in the process to advise people based on what your process is? And then tell us a little bit about how you came up with this process, or is it just de facto? It's been there for 50 or 100 years and everybody follows the same process.
Well, thank you. So the one process that I really claim is something that I put together on my own is the post-investment thesis, that from the
Okay.
time the investment is placed, that there should be a solid strategic relationship between the startup and that strategic investor, a larger scale relative to the percentage you were raising, and has strategic capabilities, which is the type of thing that I provide within the family office. It's a process that I put together from my original careers in Fortune 500 companies, of going into different operations that were not performing correctly, and many times it would be that there was actually a widespread problem that had boiled up to the
Okay.
C-suite with another Fortune 500 company having complaints and schedules weren't being met, and going in and taking a look at those operations and figuring out what are the fundamental problems here. Let's get everything on track. Let's get everything organized, and let's then present the plan, right? So that
Okay.
everybody on the outside of the operation, meaning in the analogy, everyone outside, the investors outside the startup, know, hey, look, we got it together. We know what we're doing in this regard. If there's maybe a software hiccup or something that's forcing a delay in schedule,
This
it's
is
better to
you're,
bring in that strategic investor up front to tell them, here's what's going on. And then very well may be that that strategic investor can operate as what they're supposed to be doing is they want an exit as well as you do, right?
yeah.
So they may be able to bring in some outside counsel from their business relationships or somebody else that can come in and foster some brainstorming of how to get things going in the interim, while and pull in a smaller revenue plan while still keeping the major goal that's set. So
Okay.
the fundamental that I have is a methodology from the time of investment to operate with the strategic investor as an alliance,
Okay.
that
So
they can provide you things and you can provide them things, rather than it just being, we'll send you a deck once a month that's an update on where
yeah.
we are.
So that you've opened the door for me to ask specifically what I really enjoy, and I haven't had the feedback from listeners yet, but I expect that they would be similarly situated. Do you have any anecdotal stories of pitfalls or legal catastrophe or legal successes that helped you arrive at this process, or anything on point that you've seen in recently or maybe deep into the past?
Sure, sure. Going back a ways, um,
Don't name names, protect the parties.
I promise you that's one of my fundamentals, right? So I
Yeah.
am going to kind of be a little high level here and there, because that is one of my core beliefs for anybody. Thank you though for the reminder. That's very important, and that shows where your expertise is coming from. Um, I have seen situations in the past, in a number of cases, where things were not transpiring as planned. And from a legal perspective, one that was very interesting was many, many years ago on a hardware development in telecommunications that had a number of different avenues of revenue
Okay.
from different products out of a core electronics function. where family offices had invested to a larger scale in it. And then it started coming around. We just need another, whatever, 150K in 2 months. And we're going to get there, right? We've got a strategic customer that's very, very interested. They hear that a lot, by the way. I hear that a lot. That's very, very interested. We're right at the edge of this product. We're going to get this product out. And then, okay, so then some of the family offices write the check for whatever's needed. And then another month goes by and there's another deck that comes out. We're right on the edge. We kind of pivoted a little bit because we got a new strategic customer and they're just about to sign. And we've moved the product focus a little bit, same core electronics, but in a different way. We've pivoted a little bit based on this one. And then they get the same message in another 6 weeks or so. Well, from a legal perspective, what turned out to be interesting, I'm going back quite a ways. And so I learned this many, many years ago. What was interesting is that there turned out to be a problem where the company was not going to succeed. The startup was not going to succeed without immediate funding. And it started to become, well, what can we do as the several family office strategic investors? What can we do to resurrect this thing? What can we do to take it over? And the CEO was happy just to go, hey, you know what? I'm just going to get out of this. Because it's not working. So the CEO was working with the family offices going, well, I don't know what to do anymore. And through me being involved in the operation and at that point, it became an urgency to hold business reviews. So then I'm coming in to hold the business review with the company and also even some of the suppliers that were strategic consultants in there and figure out really what is not happening to get this to success. Well, from a legal aspect, it came about of an understanding that board members that were, I should say it the other way around, investors that were sitting on the board were actually taking a risk when they started to talk about an acquisition or a merger acquisition of the operation, that they were actually advised very quickly you had to get off the board, several of them, because they're operating on two sides of the fence in this legal aspect, right? Of saying, hey, we're gonna take it over. Well, wait a minute, you're operating as a board member within the company. I'm staying away from the details because this isn't always true. But
I've seen it.
Well can be contentious, or actually there's legal implications in some cases of being on a board if you're an investor and you're looking to do something that is against the initial plan of the company, I'll say. And that's where somebody like you comes in as another level to make sure that the situation's understood.
Absolutely. That does happen when you have deep industry insiders with extensive experience. Those are the people that you want on your board for strategic investments and alignments, but they do have multiple interests. And so that's a great point. Thank you for bringing that up, John.
It works out in the beginning, but at some point there may be reasons that person has to get off the board for the best interest of the overall situation, including their positioning.
Absolutely. Yeah, I've been involved with a number of companies doing exits for various reasons and had to work with board members recusing themselves, bowing out, being screened off, or not participating in certain offers and auctions for positions. So that's an excellent point. Thank you.
Yeah. Another one, do you want to bring up another one?
Yeah, absolutely. This is what I love.
Sure. In a water treatment company that was working with, again, various applications of they had a containerized water treatment operation, and they had, again, a number of product avenues that they could go
Yep.
down, and a number of customers that were interested in various applications, and they really weren't understanding why they couldn't get anybody onboarded.
Okay.
And so a family office asked me to take a deeper look at the situation. And so I formed a relationship with that startup to make sure that they didn't think anybody's coming in as a negative persona or a negative entity, to take a serious look and look at whether there's an exit or something that needs to take place. But I tend to go in and take a look and figure out what is the solution aspects to it. We, through bringing in the investor, strategic investor, and holding the appropriate business reviews, small scale first, larger scale later, really got to the understanding that the customers wanted to get involved, but they didn't know how to implement the product into their equipment, integrate it into their systems.
Okay.
And so each one was going to require a large scale amount of handholding. And the startup didn't have that manpower to be able to give an exorbitant amount on an individual basis.
Okay.
And so from holding the business reviews, me operating from the investor perspective, I formed the idea of a center of excellence, where this startup then formed, it was an international company to the US, formed a US center of excellence to be able to decipher customer needs and provide the integration support that a customer would need. Again, lowering the barriers of entry from the customer perspective on use of the products.
Okay.
And so legal then came into mind there, because it was an international company, and all of a sudden they had an immediate desire. Everybody bought into the idea of, wow, this is great. Others can come to this center of excellence for water solutions, and then your products are in the core of that, and being able to get the applications engineering and application support. Well, immediately there was a new need for a different relationship of legal to be able to form that U.S. entity and to have it tied back to the mothership startup company.
Okay.
And having that be another international relationship. So
Interesting for sure. Do you have any more anecdotal stories or more details on the process that you use on onboarding, and maybe what the perspective or expectations of the startup would be in differential valuations that might come up, or how there's value add with these strategic partners and part of your process?
sure. Typically, as is true with well-formed, longer-standing companies, internal problems, they want to keep them internal and get them solved internally.
Okay.
They don't want that getting out. And
I
there is
understand
some
that.
level of that takes place, and it's a natural behavior and such, right?
Yep.
In Fortune 500 companies, many times when they are operating with another Fortune 500 company and they're jointly developing a larger scale product, and they both have their own portion that they're putting together that still will be multi-million dollar in the individuals, they will have periodic reviews where they make
Okay.
sure that they're completely aligned. Well, the startup if they're operating with best practices, they better already be having these internal reviews for
Okay.
development, either if it's a software as a service or a hardware development, or it's just another type of function. In their development cycle and later stage, they should be having organized business reviews. And you can have streamlined ones more more often, and then
Okay.
larger ones, sprints. In other words, in short ones, are we on top of our problems? Do we have any holes? What's the risk mitigation and such? Well, those
Okay.
should already be in place internally.
Right.
So the analogy to Fortune 500 is that if you're already doing the best practices inside, then to have a periodic review where you bring in, again, your strategic investors, not all your investors, but your strategic ones that provide you proactive value in return, to bring them in and make sure they're aware of all of the issues on a regular basis is actually a good thing. But if they're not done regularly, then you're having to dump a whole bunch of bad things at once rather than making sure they're aware and why you're going to need a raise, an investment raise in 9 months, rather
Okay.
than waiting 8 months and saying you need it. If they're strategic and you bring them in to these reviews on a regular basis, they're going to understand that you're operating in a way that you're on top of best practices.
Yeah.
And they also then they can be on the when they're not in the reviews periodically thinking about, oh wow, you know what would be a great consulting relationship that I can probably get off this other family office at no cost. They'll just come over and take a look at it and see if there's a longer scale relationship that could be there. You can end up bringing in outside entities to solve problems and make things more efficiently. So
Mhm.
fundamentally, these should be taking place on a periodic rate
Right.
for, again, larger scale investors, either investment firms where you've been brought into a fund, larger scale, or in the family office domain. And then they can continue to be looking for other ways of strategic exit to be able to pull in the revenue and also then being able to get that revenue up and taken off along with moving in the exit planning.
All right. So I'm hearing a lot of, and these are like first principles. There's communication, um, uh, being accounted for, taking responsibility. Is part of your process of that, post we're in as a family office. Do you have a hard and fast rules or minimums that you would advise for, meetings need to be weekly, monthly, quarterly? What is a best practice, if any?
Well, the business itself and its development is going to have its own meeting review plan. Hopefully, they're doing them at some level weekly, which may be more of a sprint type format. It doesn't have to be a physical meeting, right? On a weekly basis. There's various ways to have a sprint format. And it's really dependent on what is being developed and the how intricate that development is and how many different issues and broad scale it is. But there should be weeklies. There should be a more serious monthly type review, and then certainly a quarterly. The
Okay.
function within the company is to make sure that everybody in the development of that company is all aligned on
All
what
right.
is transpiring. Finances, they need to understand where the money's going. They need to understand that there may be an expectation that there has to be an infusion into engineering or into operations or into marketing in 3 weeks. and not if something isn't going well still in 3 weeks, there may be that need for infusion, and not be brought into it the last minute with a, what? Oh, I didn't even know there was a problem there.
Yeah. Yeah.
And with the augment of our electronics capabilities, now there's even more ways to do these sprints and keep everybody
Yeah.
efficiently up to speed on all of those, where they're doing a weekly, at least a monthly, and then quarterly internally. Now,
Okay.
from the outside entity of bringing in a strategic investor into that process of that business review, that's not going to be on the weekly or the semi-weekly. It may be, if the strategic investor has the bandwidth and somebody appropriate on their team, maybe they do sit in on a monthly review.
Okay.
But it would certainly be quarterly, where there would be a larger scale one, where that proactive investor could be coming in and saying, oh, I know some way to help in that regard, or we have some expertise through another relationship, or even in-house, right? The
Sure.
brainstorming thing, and go, hey, kind of like the water center of excellence. Well, what if we did this, right?
Yeah.
And to bring in some new eyes into the operation, and that
All
have
right.
that business expertise, because they are a family office or they're a venture firm. They have a multitude of capability in there. You
Okay.
don't want to overload the operation with, obviously, with meetings and reviews and things like that. You want to add them into the existing plans. And you do that by having them on a regular basis,
Okay.
so that you're not waiting until you have a stack of issues and you're saying, if we don't get cash infusion, we're not going to be able to make it another 6 months or something like that. Use them as a strategic alliance.
I get it. Um, is there any more tips that you have for onboarding the process? Do you want to share any anecdotal tips about exits? I'm interested in, what's on the cutting edge of technology right now, and how offices might be using art, AGI, generative artificial intelligence. And I don't want to go down a rabbit hole if we don't have time, but
I get it.
besides the fact that you're probably being approached by 100, 200, or maybe 500 business plans a year. And it seems like about 3 years ago, everything had a ledger or some sort of blockchain associated with it. Now everything has generative AI attached to it. Are you seeing the implementation on your side of family offices and VCs using those tools, or are you seeing an interest in investing in particular?
Sure. From the fund, the private, say a private equity fund, or separately a family. Well, let me streamline a little bit. From a family office operation, where they have a back office and a front office, a larger scale family office, where they actually have those. Some of the software packages that they will use for back office operations, tax accounting, and other financial internal management and other things in that domain. Those software packages are starting to implement AI functionality within
Okay.
them. And that can be
Okay.
true also in some ways in front offices. What is interesting is I'm having conversations with a number of entities where they're interested in providing software functionality into investor operations.
Okay. Very cool.
Now, that could be to a fund, where it's helping the fund or that venture capital firm analyze that, like you said, 600 a year. Well, they in that analysis of 600 a year, hopefully they're not throwing away that information that they had, because if they decide to get into an area that they haven't explored for a year, well, they probably made some contacts 2-3 years ago in that area. So that if it's
Okay.
an efficient database of that, they would have that information. And there's AI functionality to be able to help understand your database of either
Okay.
analyzing a new existing potential by comparing it with um, um, other companies that may be operating in the same domain, or actually going back and looking at trends or looking at prior investments of how this one may line up with other companies that you looked at 3 years ago.
Very cool. Very cool. I like that. That's going to be interesting. I'd like to have a follow up on that. I'm thinking that I probably don't want to take up too much of your time today, and we should follow up on that. I'd, I'd like to give you the floor to allow people. What's the best way for people to get a hold of you? And any final thoughts on, you know, the process that we've been diving deep into here today?
Sure. I want to touch on one more thing, if I might, for
Yeah.
1 minute. In that area of AI,
Yeah.
there are a number of investors that when they look at an opportunity, and I fall in this category of asking the question on a regular basis, what is your AI implementation plan? Now, that
Okay.
doesn't mean that they have to say they're doing something today and it's a huge amount of their operations, but they should be able to show at a minimum what their thoughts are on an AI, a roadmap for AI implementation.
Okay.
There are so many different opportunities that any startup or later stage company should be thinking about the implementation. Maybe it's in operations. Maybe it's in internal data analysis.
Uh-huh.
Maybe it's in customer support.
Yeah.
Um, and I'm only touching on a few of these. There are companies that are and projects, I'll say, that are in that investor area. They're needing the input from the companies of what the company is doing, and one of the form fills in there will be, what is your roadmap for AI implementation? And so that company should be spending some time putting that plan together. Whether or
Okay.
not they have the funding today, they may need to complete the final product in the next 6 months or whatever, but they need to have that roadmap started. The conversation then will ultimately drive putting it to a financial execution and bringing that in.
Thank you for sharing. That's a great tip. So, listeners, you need insurance, you need strategy. Nowadays, you cannot put together a pitch deck and a business plan without addressing artificial intelligence. Whether you need it now, you're going to need it later. Even if you're just building widgets for surfboards, you're going to need to address that, or to de-risk it and at least alert investors that you're sophisticated and you've thought about it. And yeah, thank you. And thank you, John. That was a great tip.
Thank you.
So,
I guess
what's the best way to get a hold of you? And we will arrange for another deep dive into venture capital, family offices, processes, and helpful tips soon.
Thank you, Eric. So again, John Samuelson. That's John, John Samuelson. Email address is john@johnsamuelson.com. So john@johnsamuelson.com. samuelson.com. Website is samuelsonenergy.com. And I think that's enough. I do have a number of white papers and briefs in some of these various areas, and there's a number of other things that we can get into, Eric. One, going down the road, we might even talk about how a startup needs to present their booth at an investor conference where they're
Okay.
spending $5 or $10 or $15,000 for a booth.
Yeah.
You want to make sure that operation's set up correctly.
Okay.
And there's a whole 20 minutes that I think would be of value.
Awesome. I'm looking forward to it, John. Thank you so much.
All right. Thank you, Eric. Appreciate it.
Take care.
Stay tuned for our upcoming episodes, where we'll cover topics ranging from business formation and fundraising to contracts and compliance. Subscribe now and never miss an episode of Business Problem Solvers. Business Problem Solvers Podcast is proudly brought to you by Eric B. Alspaugh, APC, providing comprehensive legal solutions for startups and entrepreneurs. Visit our website at www.alspaughlaw.com to learn more. Disclaimer: the information provided in this podcast is for educational and informational purposes only and should not be construed as legal advice. Consult with a qualified attorney or legal advisor to address your specific legal needs.